Hi folks, Alex Klingelhoeffer here with Exencial Wealth Advisors. That's OKC CFA CFP on Twitter. I wanted to answer today a question I've been getting from a few clients here about stock squeezes, how they happen, why AMC and GME went up so much, and what's going to happen in the future if this sorts of trading pattern continues. So a stock squeeze is reasonably straightforward. First and foremost, I want to talk about what shorting a stock is. Shorting a stock is borrowing a stock from an owner, selling it with the hopes that the price goes down, and buying it back later and returning that to the owner. Sometimes you have to pay the owner a borrowing cost, but ultimately you're betting on the price of the stock to go down with stock that you don't own yet, somebody else does. If a name becomes fairly crowded in a short trade, like AMC, typically the percent of the shares that are outstanding can reach levels as high as 60 or 70%, meaning that 100,000 shares, let's say, are outstanding, right? 70,000 of those shares could be borrowed and shorted and sold without actually being bought. What that means is functionally, if you've sold a share that you borrowed from someone else, right? In our example, there are 170,000 shares outstanding. If you have some bullish sentiment come up, like Wall Street bets, perhaps something else happens to the stock, and suddenly there are many buyers and not so many sellers, you can get what's called a short squeeze. The folks who are short, and if the price goes up, now start taking paper losses and ultimately have to cover those losses, creating additional buying demand. Remember, they sold the stock earlier that they did not own, they borrowed it, and then they're buying it back on top of already increasing buying demand. That's when you get a short squeeze. There are simply too many buy orders and too many buy orders that have to happen because of the paper losses that drives the price to stratospheric levels. So let's talk about how options are accelerating that short squeeze where too many buyers, not enough sellers, because folks have sold the stock they don't own. Well, if you're buying a call option, someone else is on the other side of the trade. Typically that call option, or the ability to buy the stock, is sold by a dealer to de-risk their position that they've gone ahead and sold to you, right? They're functionally short 100 shares if they sell you 100 call option, one call option to buy the stock. They go out and buy a percentage of those shares to hedge their bet. They want to make sure if that stock goes to the moon, they have some hedge against that option. That creates additional buying pressure. Again, additional demand for those shares because I've bought the call from somebody else. Now they have to go, and since they're on the other side, they have to go ahead and offset that risk by buying the shares, right? There's something called delta, and of course its derivatives, gamma, that causes those accelerating buying. As those options become deeper and deeper into the money, again, I'm getting a little bit into the weeds here, but as those options become deeper and deeper into the money, as the delta of those options go up, the likelihood of those options being in the money at expiration goes up, those dealers have to buy more and more securities to offset the risk of selling those calls short. So it's a twofold structure. Folks that have sold the shares short, and then dealers who have sold the calls short. As you get additional momentum, those factors pile onto one another and cause the stock of the price to rip up. So that's what a short squeeze is. That's why it goes crazy. You see stratospheric levels as folks pile into names. It's really a big rubber band that's been stretched and then all of a sudden compresses, shoots the stock price right up just because too many folks are short originally, and then additional options call buyers add gasoline to that fire and continue to bid that price up. Now, on the way down, it works exactly the same. There's a lot of folks that are long, a lot of folks sort of synthetically long ultimately, and eventually all that momentum gets washed out as folks do want to realize some of those gains create some selling pressure. You want some additional information about short squeezes, about market technicals, feel free to follow me on Twitter. It's OKC CFA CFP. Until then, I'm out.